we are covering indexed annuities for the national portion of the life insurance exam. An indexed annuity is a unique contract that provides a middle ground between the guaranteed safety of a fixed annuity and the higher risk potential of a variable annuity. When you see this on your exam, focus on the fact that interest credits are linked to an external stock market index, like the S&P 500. This is often called an equity-indexed annuity. The most important characteristic to identify for your test is principal protection. Unlike a variable annuity where the owner could lose money if the market crashes, an indexed annuity owner is protected by a floor. This floor is typically 0%, meaning that even if the market index drops significantly during a crediting period, the account value will not decrease. The insurance company guarantees that the principal is safe from market volatility. The exam will test your understanding of how the upside growth is limited. Insurance companies use participation rates and caps and spreads to manage their risk while offering these higher potential returns. A participation rate is the percentage of the index gain that is credited to the contract. For example, if the index goes up 10% and your participation rate is 80%, you receive an 8% credit. A cap is a hard ceiling on the interest rate. If the cap is 7% and the market grows 12%, you only receive 7%. You must be able to identify these terms as limiting factors on the upside. A common exam trap is a question suggesting that an indexed annuity owner receives the full gain of the index. That is false, because they trade a portion of the potential gains for the security of the floor. You might also see a question about the spread or administrative fee. This is a percentage that is subtracted from the index gain before the interest is credited. You will also need to distinguish indexed annuities from variable annuities regarding their registration and licensing requirements. Because the insurer guarantees the principal, indexed annuities are generally classified as fixed annuities and insurance products rather than securities. This means they are regulated by state insurance departments rather than federal agencies like the SEC or FINRA. If a question asks which product requires a securities license, the answer is the variable annuity, not the indexed annuity. There are several ways the interest is calculated, such as the point-to-point method or the annual reset method or the high watermark method. The point-to-point method compares the index value at the beginning of the term to the value at the end. The annual reset method looks at the increase each year and locks it in, which protects the gains from future market drops. You should know that these methods exist to determine when and how interest is credited based on the index performance. Another common confusion point is the surrender charge. Like other annuities, indexed annuities often have long surrender charge periods that can last 5 to 10 years. If an owner takes money out too early, they will pay a penalty. A helpful phrase to remember the mechanics of this product is that the floor is the core. This reminds you that the 0% floor is the core benefit that separates this from a variable annuity. In terms of risk, remember that the insurance company bears the risk of market loss, while the owner bears the risk of receiving zero interest if the market is flat or down. When comparing all three types, remember that fixed annuities have the lowest risk and lowest potential, while variable annuities have the highest risk and highest potential, and indexed annuities sit right in the center. They offer the growth potential of the market with the safety of a traditional insurance guarantee. Look for keywords like equity-linked or index-linked on your exam to signal that you are being tested on this specific hybrid product. This knowledge will ensure you correctly identify how these contracts protect consumers while still allowing for interest that outperforms a standard fixed account. Always remember that the money is never directly in the stock market, but merely linked to its performance.